What's going on, everyone? Welcome back to the bi-weekly podcast on the modern day trader. And today we'll be talking about a topic that has been on my mind for a bit. I think it's probably been in my mind for a while now, but probably subconsciously. But I think in recent times, like I'm thinking about it more and more. Um, Probably more so now that I'm like within the financial services industry as opposed to being in construction. So I'm kind of seeing it or feeling it firsthand. And the question is essentially, why aren't a majority of retail traders taken seriously within the financial services and investment management, industry? And I asked that question just because 90% of the time, the response you get when tell anyone that you trade Forex, they automatically assume that, you're gambling, you're trying to get rich quick. Um, and obviously, those assumptions tell you that they think you don't know what you're doing and you just way in over your head and you you think you're playing casino basically.
Hmm.
Um, and it's just like regardless of the way that I've spoken about it, like from way back when perhaps you did have a bit of that like those gambling tendencies, and you weren't treating it as a business, to even now when I'm talking with fund managers who I would expect to understand certain things. And just thinking about how there's a really wide spectrum of traders of like all different skill sets. Majority of them obviously fall in the unprofitable sort of area. Um, and then there's like a very, very small elite few who are consistently profitable, and some known within the industry, some not known. And I'd maybe argue, I don't know, but perhaps a majority of the ones who are known are your institutional sort of hedge fund or investment bank sales desk kind of traders. Um, and so they're taken seriously, play at that institutional level. So there's arguably an even smaller percentage of like independent retail traders who don't operate within space. And then there's quite a few of us that kind of are in between, where it's like you're not a complete amateur who's just gambling, and you're not in that elite group, made it or not. You're kind of just transitioning somewhere. Whether you're going to stay in that transition phase or not is up to you, kind of thing. But I think, if anything, you're still perceived as the large part that are gamblers because you haven't reached that other side. And so that kind of thinking about it that way is almost like as me maybe trying to make sense of it. But I think that's the question in essence, and that's what I want to put forward to you, Marcian, just in terms and I wanted to frame it in that sense so you understood like how I was kind of thinking about it, in an attempt to answer like, why does the industry not take retail traders seriously, particularly retail traders who adopt a technical sort of analysis approach? And yeah, just be keen to hear your thoughts on the question, and what you kind of interpret it or the
Yeah,
answer to be.
I think looking at it from my point of view, there's a couple points that I have, particularly with like uh just looking, if you take yourself outside of being a retail trader and you put yourself into a professional trader's point of view, like you can really start to see like just as an industry as a whole, why we not really taken seriously. And I think the first thing that like I think is like pretty big right now is short-term focus. Most or majority of retail traders often focus on like quick profits or like making profits like really quickly. And if you look at the large majority
Mm.
of professional investors or traders, generally they look at long-term growth. You know what I mean? And also with that, like a lot of the growth stems from fundamental analysis. And so now, as you mentioned, uh, we as technical traders and like majority of retail traders are more technical based. Like you already not taken seriously when you can't speak on majority of like fundamental analysis. If you can't comment on the GDP, you can't comment on the 10-year yields, or you can't comment on any macroeconomics, and you just trade
Mm.
in like technicals in and of itself, and you just trade in patterns or whatever the case may be, like you already like in a backseat compared to what they are. And then you add that with like the outlook of general retail traders, that is to make a percent in a particular day, whereas they're not looking at that. And that's like always what I've mentioned, that majority of professional traders, if you average it out over the year for each month, they make 4 to 5%, sometimes even less on like their capital per month, right? Whereas if you look at a retail trader, he's trying to make 10% in a month, like he or she trying to make 10% in a month, or 12% in a month, 20% in a month. And that automatically speaks to like the
Mm.
focus, like there's a difference in focus. These people are looking at preserving capital, whereas the retail trader is looking at exponential growth on the capital. You know what I mean? Like I feel like on this short-term focus, it's also just like looking at like the way like growth is perceived. I think very often that professional or investors in general look at the growth over 5 years, 10 years, 3, 5, 10 years of a portfolio, whereas retail traders want to see growth within a quarter, or they want to see that same growth that the professional investor is making within 5 years. They want to see it within a year, which is doable 100%. But like that in and of itself is something that makes us as retail traders not get taken too seriously when you step into a room and like you can't necessarily speak on all of, number one, what your currencies are doing with regards to fundamentals. So you don't know whether it's what's going on economically or with the macroeconomics. Then number two, you just throwing out wild numbers, which is doable, but like realistically, you exposing your portfolio to way more. And that leads me into my second point, which is overconfidence and lack of strategy, to be honest with you. Like what I've also found is that like a common issue amongst retail traders is the tendency to lean toward like overconfidence and chasing the trends, rather than developing and becoming a disciplined trader. That's why majority of traders will switch strategies, because they're so confident in what they're doing now, and then they chase that trend. Then the next thing you know, they're on to the next thing, and then they're on to the next thing. There's no structured strategy, and that like makes us appear as impulsive. You know what I mean? Whereas like when you're going into, let's say for instance, you go into a big bank and they can, you an investor there, they're gonna give you, like, gonna teach you everything. They're gonna give you all of the data. You already assume to
Mm.
be a person who can make decisions on the fly, but now you have this data to back what the decisions that you need to make, like to back that decision. And you're going to follow that data all the time, and you're going to follow that strategy all the time. Whereas with traders, there's that lack of strategy. And then along with that lack of strategy, there's paid with overconfidence, which means essentially over leveraging, right? And now you're over leveraging on a strategy that, number, you don't even know if it works because you haven't back tested enough, you haven't forward tested it enough, and you just go in ham. And then this like this creates this whole thing of like phonics doesn't work and all of those things, but I don't want to get into that. Just on the point that we're speaking about, like
Mm.
a lot of people strategy is not data driven. It's not a methodical approach, and it's just not very professional in and of itself. Like they can't speak on the numbers that they have over 100 trades. Whereas if you speak to a professional trader, it's probably going to tell you over 1,000 trades. This is what my strategy does. You know what I mean? So now, like you compare
mm,
that, it's like comparing apples to
mm,
oranges, bro. Like one person can't even take 100 trades of like one particular strategy. And then this other person took 1,000 trades of this strategy and he knows what's going to happen
mm,
over the next 10 years on his strategy. He knows he's going to have down years, but the up years are going to exceed those down years. So that's another thing. Then I think
mm,
this to me is like one of the biggest things, the influence of social media and basically the get rich quick scheme or culture or whatever you want to
mm,
call it. Like, I feel like
mm,
we're just so heavily influenced by social media, and you see these Oxford Raris, and like it just seems that like you can learn this thing in 6 months, and right enough, there is
mm,
people who catch on very quickly. But like, what are the odds of that? That's probably like the 1% of people that to catch on to it in like 6 months, right? And
mm,
like that in and of itself, if you say you trade Forex and you're a retail trader, like majority of people are going to say it's a scam. Why? Because of social media, bro. That oak that has a Lambo doesn't have a Lambo because he trades. He has a Lambo because he teaches courses. Like that, like, so now the
mm,
reason why people are not taking us like serious enough is because number one, we short-term focus, so we really trying to make profits like immediately. Number two, we like don't have a strategy that's data-driven. Pair that with overconfidence. Then number three, you have this bad light on like forex in general, and also pair that with like the low barrier of entry. You all you need is like $10 and you can start trading forex, and you're a so-called forex trader. You know what I mean? You can deposit that into a
yeah,
broker and now you're trading forex. You're gonna probably risk the whole $10 and blow it, and then you're also gonna say it's a scam. But it's all based on the fact that like you sold this dream from somebody on Instagram, YouTube, whatever the case may be. Now, there could be
mm,
people that are like really and truly like doing this, and like I feel like there's more people that are actually doing this, and like they have the Lambo and they have the things. But I also do think that majority of people that are marketers have Lambos and they are more out there because that's like their living. Like they are out there because they need to market themselves in order to make the money from a cause so that they can continue living the way they're living. And you see this oak taking 1,000 lots on
mm,
Euro USD, and now you're gonna go boom on a strategy that you don't even know what works, you don't know what it performs as over 100 trades. So I feel like those are like for me, three of like the most important things. And then just like jumping on my last point, Sam, I think there's also just a lack of professional standards in general. Because like
mm,
if you look at it, like majority of retail traders
mm,
lack formal training in finance, they lack formal training in economics, and they lack formal training in like risk management. Then you go to somebody and they're going to tell you
mm,
risk 1%. 1% of like this is what I also realized, 1% of 100,000 is 1,000, but when you only have 10,000, you're risking 10% of your capital. Like, you know what I mean? Like, yes, you can do it to pass the challenge,
mm,
but realistically, like when you have that account and you've passed the challenge, like, is that something you want to be doing? So, like, majority of professional
mm,
investors, like, they work in a structured environment, like with rigorous risk controls, and these
mm,
things are like commonly overlooked by us as retail traders. Like you're looking at like people working on Wall Street or even in the JSE, wherever, like in
mm,
like in your workplace. Those oaks have hella risk controls on them, bro. Like they need to know, make sure that they're protecting people's capital because there's actual people that's investing. Whereas you're gonna hoy a 6 to 8 bands and say, ah, nah, I'm gonna trade this 100K account, and then like you don't even know the numbers behind your strategy. Like if these people lose a 100K account, they're gonna know that it was probably a downtime in their strategy because they understand that uh their strategy has downtimes and they were probably risking a bit, like they were going a bit higher on risk just so that they can pass it
mm,
faster. They fine with that. Whereas like majority of retail traders don't even know what they should be risking in a challenge phase because they don't have
yeah,
enough information on their strategy. So those are like my points, Sam, that I have that I think why we as retail traders are not necessarily like looked at the same way if we worked at a hedge fund and we walked in and we said we worked at JP Morgan,
Mm,
for instance, and you're walking into a different hedge fund, they're going to take you pretty seriously. Whereas if you hawk in, even if you have the Lambo and you have everything, if you hawk in and you say, ah, nah, I'm a retail trader, trading forex, they're still gonna be like, ah, this oak might be selling causes, this oak might be doing this. And it's just a combination of all of those things. So short-term focus that we have, the
yeah,
lack of strategy, pair that with overconfidence, and then obviously the influence from social media, which majority of the time
yeah,
gets people into it, and then the lack of professional standards. So yeah, Sam, what do you think about just in general, as I mentioned, like that's my 4 points that I really made notes of, that I
right.
think is like one of or four of the biggest things that why we're not taken seriously. Why do you think retail traders are not taken seriously by investors?
Sure. Um, and you excuse the writing. I was just taking notes as you're speaking because there were some of the things that you're saying that I was just resonating with, and I didn't want to forget them by the time you're done. Um, but as you're talking, I kind of feel like the answer came a lot simpler because I thought about different reasons before this as to like, okay, what's the answer to this? Like, there's so many, there's this, there's that, but like, it's really like a lot more simple than that. Like, majority of traders aren't taken seriously because majority of traders aren't serious. Full stop. Not serious, and nobody else decides for you that you are a serious individual. Somebody can't say this person's unserious because
Exactly.
what has led them to that
Mm,
conclusion. It must be the way you behave or the way you are presenting yourself that leads people to a conclusion of you're an unserious individual. And I think that's obviously rooted in a lot of the things you were saying around lack of formal training, not understanding the jargon or the lingo, and obviously the principles that really are the foundation of um, investment management or financial services um, that are discussed at a professional level, um, because we think we can learn a head and shoulders pattern
yeah.
and we're gone after that. It can be that simple, but in reality, it's actually not that simple, unfortunately, or easy rather, because I'm also learning there's a difference between easy and simple. Something can be simple and you can have like a really deep understanding of it, and it can take you years to master that or get to a place where you're executing it at a certain level that a beginner might not be able to, but it's still really simple. And I think that's the challenge when like you don't come from like the formal environment and you're in a formal institution that shapes you and guides you. You're left with all these options on how to get to the end goal, but then you struggle to kind of like implement it because
Mm,
are you going to go full technical? Because if you're going to go full technical, then your strategy is really a matter of probabilities. You kind of you've got a probabilistic edge there because you understand your data in terms of what scenarios it works in, what scenarios it doesn't. You're not worried too much about the fundamentals, but it's when A plus B happens, it equals C. When C plus D happens, it's this, and there's probabilities of that under certain, scenario. So it becomes very technical in that sense where you try and make it as mechanical as possible, but then you understand where the discretionary gaps are, and even then you add a bit of mechanical
mm,
processes to the discretionary side of it. Or it's a combination of both, where it's you've got technical and fundamental. Your technical obviously is the more strategic side of it that informs the bias, whether it's top up or bottom down. And then your technical, you use it more as a timing thing to refine your entries, which is what a lot of the guys do. Or you go full scale fundamental. But it's like a lot of traders are sitting on the technical side and thinking that, and just not understanding their strategy to the extent that you're explaining, where
mm,
you've collected data, you know how it performs. Because at the end of the day, it's you could not speak the lingo or the language of, these institutional players. But if you've got a strategy that you've over the 5 past years, you've just built data. You don't care what people call things. You can have your own name for things, but you've got data that shows that your
Yeah.
strategy year on year has performed, has an annualized return of like 45% year on year. There are investors who will have appetite for your fund if you also know how to present it, because it's not just about your strategy, it's how do you present this and sell your idea, your fund,
Mm.
basically. Because I think that's what a lot of guys in the institutional space get good at. It's sales, it's pitching, it's closing. But when you get to it, and there's a few things you were saying that I didn't disagree with, because I think there's similarities in the institutional space, which is those oaks still use a fuck ton of leverage, bro. And that's a root of a lot of, these big hedge fund failures, is that they were just over leveraged. On paper, it made so much sense to investors, but the fund still got liquidated because they had like 140x, 1 is to 140 kind of leverage going on in a position. That's mad. Imagine you're already trading like $50 billion, but you've got 140x of a position on that. So these oaks also have like this gambling nature to them that's very similar to a lot of retail traders. But I think because they've been groomed by the environment, they're able to not trick investors, but use their network to influence investors to buy into their ideas, even if there's nothing there. So they can talk the talk, but at the end of the day, they still can't walk the walk. So I think to sum it up, it comes down to, like you're saying, just a strategy that you've tried and tested, that you have solid data on and you've taken seriously. Because a question that kind of arises from this is, how serious am I about this? And you should constantly ask yourself that question, because it's easy to feel like you're doing everything right, and that you get that overconfidence and you feel like, nah, I got this, bro. But it's like, check in with yourself. Like, is what you're doing now really gonna add up to the life that you want to live? And if something feels like it's like, it can't be that simple, don't doubt yourself, but also listen to that. See where your gaps are and see what you can do to improve on like your processes and stuff. Just like go deeper, because until you obviously get to where you want to go, you can arguably always go deeper.
Yeah.
So if there's a disconnect between like where you are now and where you're trying to get to, but you think you're doing enough, then you're probably not doing enough. You're probably not as serious as you think you are. So how serious am I? But then also on the other end, to be able to raise funds or raise capital, if you want to get out from the prop firm space, or if you don't want to just trade your own capital, you got to be able to present your strategy and sell it in a sense. You got to talk the talk too, in a sense. It's not just about being able to trade, especially if you want to build something that will essentially one day maybe run for itself. So that's kind of the 2 cents that I had on it. So yeah, that's what I would say contributes, like the things I spoke about. I think those all contribute towards how to become a serious trader, because it goes back to that thing that I said of like, nobody can decide for you whether you're serious or not. I think people's perceptions will always be that someone can call you unserious, but you're a 7-figure funded trader. You live off your trading income. You know, you could just say, bro, you're talking shit. Like, you don't know what you're
Yeah.
talking about. So it's like nobody really decides for you. You got to decide for yourself how serious you are when it comes to this. Um, and I think maybe I asked the question because potentially I wasn't serious enough. Because also when you got to keep asking it, obviously, like I said, when there's still that gap. But I think the more things start to align, the more you realize that you're doing enough, and you can speak about it in a proud way because you are serious about the work that you're doing. And so if there's any takeaway from this or anything you found interesting or useful, let us know in the comments below. I think these are the discussions that kind of drive us forward psychologically as traders. So remember, guys, consistency is a choice you make when you start doing the things you know you should be doing day in and day out. I didn't see the timer there at the top saying 9 minutes. I thought it was like we had seconds, bro. So I really just cut that thing out there. No, I
All
think
right, no
that's
problem.